Welcome to The Derivative by RCM Alternatives.
Send it.
All right, we're here with Robert Mullin. Thanks for having a nice, easy name I can pronounce easily.
Hey, no problem, Jeff.
Are you a Robert or a Bob or always been a Robert? What's the story there?
So I'm a Robert, but I am the son of a Bob and the father to a Bobby. So it just,
Whoa.
from keeping things straight, Robert is the most functional one that I can use right now.
I've got a good friend, Italian family, and the father's named Dominic. My friend, the son's Dominic, and then his son's Dominic. And the mother has some way of like screaming, Dominic. And they know. She says the same thing, but they know by the intonation which one it is.
Yeah, exactly. A certain twang to it gets the attention of the proper Dominic.
Love it. So wanted to have you on, talk the big news here to start the year of U.S. grabbing Venezuelan oil, or is that a smokescreen? So we'll just dive in of kind of let us know your off-the-cuff thoughts. Did that knock you off your couch, or you were sort of expecting it, or what were your first thoughts? And then we'll kind of dive into what's going on there.
Sure. Look, well, I appreciate you having me on. The idea of us leaning into what's going on in Venezuela has been pretty well telegraphed for a while. The swiftness with which it was achieved was, I think, surprising to a lot, myself included. That said, it was unbelievable the number of incredibly bad takes that were on the sort of X, Twitter sphere, et cetera, and even in some of the mainstream financial press about the likely impacts on the energy markets. So there are a few things that I think the world got right? And I think the people calling on Saturday and Sunday for oil to go straight to $40 a barrel, clearly the market looked right through that and said, it kind of opened flat, which you would think with a, big change of hands of what is being touted as the world's largest energy reserves, which has kind of a story off to it all by itself. It's actually
we'll stick
really
a pin
not.
and come back to that.
Yeah, exactly. But so it got that right. So, the oil price kind of being flat, I think was right. Some of the way the energy equities reacted, I thought were pretty reasonable, if not maybe a little bit overdone. Because I think the big beneficiaries, at least in the early phases of this, will be the companies that help, in theory, rebuild the infrastructure. Once you stabilize the country, once you actually go and pay back all the people that Venezuela and PDVSA, their national oil company, owe money to. But the first beneficiaries are going to be the people who help to rebuild it. The two takes that I kind of disagree with. One is that U.S. Gulf Coast refineries are going to be immediate beneficiaries from that. I think that is at this point, kind of a ridiculous take. The idea that we have this new flood of heavier crudes that benefit the Gulf Coast refineries of the U.S. that are geared to run these heavier crudes.
And real quick, are they even set up to accept oil from the sea, right? They're set up to accept it from pipeline.
No, but the Gulf Coast refineries can take it by ocean too. And Venezuela has historically been a big provider of Gulf Coast crudes. The refineries were built there to accept Mexican Maya crudes, other things from and the refining network in the Caribbean was to take these sort of South American crudes and kind of pump them into the U.S. refining system before we had enough of our own crude production to be able to fill them. So they're right technically in that they're geared to run it, but the fact of the matter is, I think the likelihood of incremental barrels coming out of Venezuela in the next 12 to 24 months is virtually zero. There's a huge series of things that have to go really right for Venezuelan production to rebound from where it currently is, which is about 800,000 or 900,000 barrels a day, to even think about 1.3, 1.4, 1.5 million barrels a day. You've got to stabilize the country. You've got to pay back all the people who are owed money. You have to convince energy companies that in an area where you have to invest for a life cycle that's going to take decade plus to get your capital back to you, you have to believe that there's enough stability there that it will outlive the 3.5 years left of the Trump presidency. This is not something that can be made on a political timeframe. And you also, quite frankly, the break evens, the way I look at it, you have to both rebuild the entire infrastructure, electrical, roads, transportation, processing, diluents, all that sort of thing. It's going to be about 3 to 5 times more expensive to do that in Venezuela than most companies have for prospects that are already on their books that they aren't doing. So it kind of just, if you think that much money's flowing down there, you got to believe that oil prices are $80 to $100 a barrel. So to take this as a crude prices should go down and massive flood of cheap, heavy barrels goes to the Gulf Coast refiners and it's going to be happy days for them, I think is kind of nonsense. That said, that's what the market has grasped onto.
Lots to unpack there. I'll start with is Venezuelan oil is kind of in their bay there. I don't know what it's called, right? It's underwater or is it in the ground?
So there's actually, they have both offshore and onshore production. And like the Orinoco Basin, which is where the majority of the reserves are located, that's reasonably inland. And you have to kind of produce that, get that to port. And so absolutely, port infrastructure and export capacity is going to be something they have to rebuild. First, you have to build the electrical grid. Right. I mean, this is a country that has been in massive underfunding disrepair for the better part of 20 years. So stuff has been picked over and cannibalized. And it's the idea that you can go in and snap your fingers and that there's a lot of oil behind the tap that's easy, low hanging fruit, I think it's just a fallacy. It's wishful thinking for people who really want oil prices to go down for whatever reason.
And why was that? Just the corrupt government and corruption there, and no one was willing to invest?
Yeah,
Didn't we have U.S. companies and China was putting money into there?
Yeah.
So how come that money never fixed the infrastructure?
So it went in a long time ago. So Exxon has now had 2 rounds of confiscation of the assets that they've built down there. Chevron has been able to navigate relatively well. So they've still got, I think roughly 300,000 barrels a day of production. But it's a smidge on what they do. And it's been really expensive and politically challenging to maintain because Trump just sanctioned that stuff back in February. So they had to ramp production down before ramping it back up over the last 3 or 4 months. The Russians are there. The Chinese are there. That's another 200 to 300,000 barrels a day of the production. The rest of it is the PDVSA, which is the national oil company. It's like going back to something in the but even worse because no one's been paying attention to it. What they said when Chavez came in and basically PDVSA nationalized and took all these assets from everybody, they effectively fired everybody with a college education who worked at PDVSA. And the way I've had it described to me, and this is going back 15 years, is that you all of a sudden threw all the computers out the window and you started working with carbon paper. So it's literally Stone Age. And so it's
on purpose to be like, this is ours. Here's how we run it.
Exactly. Well, and to the extent that they could not afford to reinvest it because they were taking all the money that PDVSA produced to hand out in social programs to be able to, to buy votes and to placate the masses and to make oils cheap and gasoline cheap for the masses. And you can only do that for so long before the engine that fuels all that starts to seize up and doesn't work anymore. And that's prototypical socialism, right?
Right. It's interesting to me, like, this is more of an 1800, like early 1900s where governments were taking oil, or vice versa. It seems like all the other plays in the last 100 years have been countries taking their stuff back, right? Egypt, Venezuela. So that was kind of a perverse inversion of that, of like, no, we're giving it back to corporations instead of the state.
Yeah. So it's gonna be an absolute quagmire for an extended period of time.
I jotted down too. You mentioned a couple times who these are people that are owed money or companies that are. So what does that look like? Big national oil companies, banks.
Yeah, ConocoPhillips is owned about. Yeah, ConocoPhillips is owed about $8 billion. That's been in court for a decade. ExxonMobil's north of $1 billion. Schlumberger, Halliburton are both $500 million to $1 billion. So those are big checks for a country with no cash and a huge amount of debt to be able to figure out, who's going to pay that back? So first you have to pay back the people who are owed money because you got to get them back in to actually develop it. Then you have to get, by my estimate, to get 500,000 to 1 million barrels a day in the next 5 years, you've got to spend somewhere between 60 and $100 billion. In data center land, that may not seem like a lot of money, but
whatever.
everywhere else in the world, that's a huge amount of capital. And so where does that come from? So start giving me those answers and then we can talk.
Sign it off, right? Like, hey, government will back all these debts, get back in there.
Yeah. So If there is a point where the government does like they've done in some of the rare earth areas, where they guarantee returns and offtake and back, maybe sub market interest debt, then maybe you can start talking about doing it. But doing that in the midst, I mean, think about if they tried to do that in Afghanistan
Yeah,
or
yeah,
in
yeah.
Iraq. I mean, think about what people would think about that. Just because Venezuela is closer to us doesn't mean that it's easier to exert our will over an unstable sovereign nation.
Right, with 25 million people or so, right?
Yeah, I mean,
Um,
unless we're willing to put 50,000 troops on the ground, which, look, we could do, but I think the public might not like that a whole lot.
and what kind of companies that will build it? We're talking the big of the big. Like you're not
Yeah.
going to get some small regional operators from Texas down there or something. This would just be
Yeah, so it's interesting. So I think the big money will be made by, international oil companies, and they'll have to be the U.S. ones because with Trump kind of, exerting his influence there, it's not going to be the European majors. It's not going to be Shell. It's not going to be BP. So it'll be the U.S. focused majors. Chevron will be probably at the front of that because they're currently there and operating. And it's just going to depend on, whether Exxon thinks it's even worthwhile to go back in there. Again, since they've had stuff confiscated twice. So their long-term return on capital in Venezuela has probably been the single worst investment in the long storied history of Exxon. So
wow.
whether they even care to go back for 500,000 barrels a day over 4 or 5 years, I don't know if they would. The service companies, I think, are going to be the big winners, the guys who build the offshore projects and infrastructure. There's going to be some E&C companies that are involved with rebuilding the electrical grid, processing and transportation, and that kind of infrastructure. So those folks will be the kind of on the first line of winners. I do think there may be some smaller companies that go back. There's some really interesting. I wouldn't think it's like the shale producers who then all of a sudden port themselves down there to
Yeah.
do it. There are some really good Latin American companies, many of whom are staffed by former Venezuela, PDVSA related engineers who know the basin really well. And so there are some independent oil companies, in kind of down Latin America, South America, who I think will probably play a role in this and I think are well suited to do so. But, first things first, you got to stabilize things down there.
You mentioned the world's largest reserves
Yeah.
ish. What's the ish part of that?
So Venezuela, so 300 billion barrels is what everybody cites, and that's what is the bigger number than Saudi Arabia, and so they have the biggest oil reserves. If you look at their evaluation of their own oil reserves, it went from about I think 30 billion barrels to 300 billion barrels over the course of 3 or 4 years, according to their own reserve engineers, and that was in response to OPEC started setting OPEC quotas as a byproduct of, guess what?
Your
How
reserves.
big your reserves are. So there's I think an enormous amount of fudge factor in those numbers. Yes, at $400 oil, they probably have 300 million barrels of reserves. At $50, WTI, my guess is their reserves, their economic reserves are, a small fraction of that. And all of, not, I won't say all of it, the vast majority of it is very technically complex. It is both heavy, so it doesn't run very well. Some of this stuff, the moment you bring it to surface, it coagulates and hardens. You need to mix it with lighter crudes or natural gas to even let it flow through a pipeline. So there's a lot of infrastructure that has to go in, and it's super sour, which means it's got a very high sulfur content, which means you have to reduce that sulfur so it doesn't corrode everything that it comes into contact with. And that's kind of the nasty stuff that you don't want to end up in with your gasoline or your jet
Yeah.
fuel or anything like that. So that's got to get stripped out. And so it's mostly very low quality stuff.
So like almost the exact opposite of Middle East Saudi oil that's just coming out near
Yeah,
perfect.
so a lot
And
of
what's
Saudi stuff is good, but like the Iraqis and Iran and Iraq both have significant
yeah.
kind of heavy sulfur barrels as well coming out of there.
Hmm. And so what is it? Do you know off the top of your head? I didn't prep you for that of what that price to price cost of production is to get it out of the ground down there.
Yeah,
I
it's
mean,
it's hard to say because they haven't
assuming all the infrastructure was in place. Yeah.
yeah, I think op costs down there have got to be north of $30 a barrel, and it depends on how much you fully load it with the infrastructure. So that is sort of wellhead, tieback pipeline. But then what people will really have to spend is all the money to build out the rest of the infrastructure. As I said, the electrical grid, because you can't run all of this stuff without an electrical grid to pump the pipelines. You can't run it without the ability to be able to turn on the lights in the processing and desulfurization facilities. So all of that is, if you load that on, so the metric that I use is a good heavy oil project around the world costs about $30,000 a flowing barrel to be able to get online. So that's capital costs, not operating costs.
Yeah.
I think Venezuela is going to be 2 to 3
30,000 a
times that.
barrel.
30,000 a daily flowing barrel. So what you want to see from that gives you an idea of, look, if I think the number for Venezuela, let's use round numbers, is more like if you're fully loading it for all of the infrastructure that you have to do, and it's $100,000 a daily flowing barrel, to get 1,000,000 barrels a day, you got to spend $1 billion. So it's $100 billion. So
Yeah.
it's
It's a lot.
it's going to be really hard.
You mentioned the tankers. We did a podcast to finish last year with a professor of maritime professor. We were talking shipping and tankers and like massive underinvestment there as well, right? So that's another piece of this of like, how are we going to, even if we can get it out, how are we going to get it to where it needs to go? But do they have their own fleet of tankers? Venezuela, no? Are those super old?
Venezuela has some of their own flank tankers. They use what's generally referred to as the shadow fleet, which is typically a lot older tankers that are flagged in Cyprus or some kind of offshore place that
I think that was something out of Star Wars, the shadow
yeah,
fleet.
exactly. Non-compliant tankers that can't port in respectable jurisdictions. And so that's actually a big part of the global tanker fleet is what we call this shadow fleet. It's old boats that I would say are generally characterized by being held together with duct tape and baling wire. But their reason for being is that, we've had sanctions, sanctions on Iran, but you still see Iranian barrels going to India, sanctions on Russia and Venezuela, but you still see those barrels going to China. And it's because we've had sanctions, but we haven't been enforcing the sanctions. So it has facilitated the rise of this shadow fleet, which is about there's about 1,000 VLCCs, very large crude carriers on the water right now, and about 100 of them, a little bit more, are what is called this shadow fleet. So it's boats that if you did not have a sanctioned market where they're operating in the shadows, moving crude that the rest of the world is saying you shouldn't be doing that, these boats would have been retired and scrapped. Sometime over the last 3 to 5 years. So that's the interesting dynamic to me. I think there's both the fact that there's going to be more barrels going around, but I think you've got a big portion of the tanker fleet which has been a byproduct of a sanction environment that can go one of two ways. One of which is you decide to actually enforce the sanctions, which is what the U.S. is doing now, and actually boarding tankers and confiscating them. Or you have peace in Ukraine, peace in Russia, you stop having the sanctions. So there's no reason to have this shadow fleet anymore, and people won't use them because they're really dangerous, quite frankly. And they charge more than normal tanker fleet because they're doing things on the dark market. So it's got a lot of dynamics, but I like the fact of being long tankers because it hedges if I'm long energy stocks too, one of the risks that I have is that OPEC increases production. And that was played out very well last year. So if you were long energy stocks in 2025, it was kind of a tough year. But if one of your vulnerabilities was more barrels coming from OPEC, which is what we got, that was really good for the tanker companies. So it's kind of like a long that hedges a long.
I'm thinking of the shadow fleet of like Dennis Hopper's tanker in Waterworld. Remember, he turned it into the evil base. And then did you see the story where they were trying to get that Venezuelan tanker and they painted the Russian flag on the side of it real quick? Like, no, this is a Russian vessel.
Yeah.
Crazy. How does that even work? Are they just making them man the tanker by gunpoint, or are there U.S. Navy guys that then are operating the tanker? I'm probably stretching the limits of your knowledge, but
exactly. The attempt is you go in, you board it, and they're not going to put up a fight. They know that the U.S. military take them out in a heartbeat. So they all stand on deck with their hands up. We board them, either by boat or by, fast helicopter. And they go on, you bring on a pilot, and boom, you say, we're going to drive this to the Gulf of Mexico, or Gulf of America, as we now call it, I guess.
Yeah.
And these are our barrels now. And guess what? We're probably going to keep the boat, and it's probably a piece of junk. So we'll just drive it to the shipyard ourselves, and we'll get $20 million to scrap it.
We're proper pirates now.
Yeah.
Sir Francis Drake, we're like authorized by the government, authorized pirate. So you're not even, this is the part where I'll tell everyone, you're not even really an oil guy, right?
So actually, energy is a decent part of what I do. I'm a broader resource guy, and I'm not a trained geologist or anything like that. I've just been kicking around on the investment side of the natural resource sector for 35 years now. So I was originally at the Franklin Templeton Group, left there in the late 90s or mid 90s, and have been kind of running resource-focused investment deals, mostly hedge funds, long-short equity funds, for the better part of now 35 years.
At Franklin Templeton, you were equity guy, but that was your focus?
Yeah,
Energy
I ran the natural resource.
Yeah.
I ran the natural resource fund there. I covered energy as well as a couple of other non-resource sectors, consumer products and cable and things like that. But energy and the resource sector were what kind of captured my imagination. And my family history is my mom grew up on a cattle ranch in West Texas. And so I've always kind of been close to the idea of real assets and tangible commodities.
Our Sam has a whole ag unit that does a lot of hedging and working with the farmers, dry land cotton in West Texas.
Yeah.
Which seems like a brutal business.
Yeah.
No water.
Well, I mean, look, the entire history of options goes back. I was just driving my son down the peninsula, who's a very bright senior in high school right now. And I was telling him about the podcast that I was doing, and he out of the blue said, "Yeah, do you know that the first options were on an olive press, back in ancient Egypt?" I was like,
nice.
Really?
No.
So I didn't have a chance to do diligence it, but it was effectively someone who was wanted to secure the right to use an olive press going into the season that apparently, at least in one YouTube video, is the original option that was written.
I love it. I always tell people, they're like, what are futures? What do you do? I'm like, well, I like to call them nows, right? Everyone thinks you're guessing the price in the future. It's like, no, some producer wants to get paid now for what he's going to give you in the future. But I digress. So is resources even a market sector anymore? It seems like it just morphed all into energy, right? Is natural resources still a legit market sector?
It's still a thing. Look, it's a lot smaller than it used to be, back in, the early 2000s, the energy plus basic materials plus, ag and all that sort of stuff was 16, 17% of the S&P. Now it's less than 5. So it's still a legit sector because, quite frankly, none of the world works without it. But it's gotten a lot less mind share from the investment world for quite a while. And I think augmenting that was the kind of ESG decarbonization movement that not only made it, in many ways, it was sort of out of mind, but you were punished for even thinking about being a contrarian and owning commodity stocks because you got bad ESG marks. So that pendulum seems to be coming back a little bit. And if you get a real commodity cycle, which I think we're in, we can talk about that if you want. If we're in the midst of seeing that develop, then I think you're going to see a lot of people sort of forget that sort of strict interpretation of ESG and take a more pragmatic look at how their portfolios should be allocated.
Well, do you ever bristle at a commodity cycle? I sometimes bristle at that because I'm like, well, what are we talking about? Like energy could be going gangbusters, grains could be at zero, precious or base metals could be doing totally different things. Like to think that the whole commodity market is going to cycle at the same time, I kind of bristle with and don't always agree with, but yeah.
I totally agree with that. That's what makes it such a fun sector to be long and short in.
Yeah.
Is that there are wonderful opportunities to be long, even sometimes within the single sectors. But there's lots of different opportunities to develop over, I'd say, the short term. If you look intermediate to long term, commodity cycles do tend to line up a little bit. If you look at industrials versus precious versus energy versus, and you look at, 150 years of history on those things, I think, my buddy Rob at the Crude Chronicles and a couple of other places have done some really good work on this. They do tend to move in relatively synchronized cycles. Sometimes it just takes 2, 3, 4 years for everything to kind of sync up. And I think that's where we are right now, in that precious kind of led the way. Copper is following. That's pulling up some of the other metals along with it. And I think energy and ags are kind of in the caboose, and that the sort of path of least resistance over the next 2, 3, 4, 5 years for those two sectors in particular is higher.
Yeah. My zag would be like the grains are just they're always going to be in the caboose. They're easily replaceable, substituted. It seems like whenever we need more production, someone comes up with a new technology or method to farm more, which I could also argue is the same. And right, like we used to just drill down in the Gulf of Mexico. Now we can drill down 1,000 feet and then sideways 1,000 feet. So like the technology has almost outpaced the demand, right?
Well, the
increase
tech,
in
no
demand.
question. The innovation and technology in the energy patch has gotten way better. Absolutely. The peak productivity of that innovation was really kind of hit its zenith, 2020. 2021. And since then, incremental barrels are getting slightly more expensive. And so the question is, the technology doesn't get any worse, but the ability to apply it to a resource base that is not universal. Like the entire U.S. is not that 10 counties in in U.S. shale land that are massively geologically fantastic and endowed to do exactly what we're doing. And the nature of any exploitation cycle is you go after the most profitable stuff first. You spend a bunch of years drilling it out, and you figure out, where is my highest ROI to drill today? And that's the stuff you drill first. And as you get further into that cycle, the technology benefits are offset by deterioration in the underlying asset quality. You're going into what in the Permian they would call kind of second tier and third tier rock. Technology can make the rock look a little bit better over time, but it can't totally offset it. And if you read like the Dallas Fed notes that have a lot of individual quotes from oil and gas producers in the Texas pan, and they're all like, if you think we can drill at $50 oil and make money, you're smoking the rock, right? It's just,
You got
it's
another
just
thing
not,
coming. Yeah.
it happens.
Thus the $30 Venezuelan oil.
Exactly.
Yeah.
Yeah.
My end game for that is always people like, oh, we're gonna mine asteroids for these resources. I'm like, that's the ultimate in like, well, what does the price of that stuff need to be in order to make it feasible to send a rocket into space, do mining, and then get it back on the ground?
To me, anytime you move anywhere from sea level, so what is true in space is also true in going down into the ocean and those sorts of things. And there've been 3 or 4 generations of like, yeah, we're going to go out and pick out these great high grade pipes that are coming up from seafloor seismic or volcanic activity. It's like it's the cost curve on that is ridiculously high. So yes, I think both of those, the exploitation of resources gets logarithmically more expensive the more you move from sea level.
So have you always been equity based?
That's the majority of what I do. I do a little bit directly in the commodities. I do a lot in sort of the volatility space. And that's something where we've got kind of a constant long volatility book to offset either some of the broader market risk that we look at or some of the sector specific risk that we see within our various energy, ag, industrial, metals kind of verticals. So I'm kind of a hunter for cheap vol and just kind of accumulate it and warehouse it. And it's not a big dollar amount of what we do, but it's a useful punch to have in your back pocket when markets get squirrely, which I think they have periodically done over the last couple of decades. And I think they're likely to do more of that over the next 3 to 5 years.
So that explains how Jason Buck introduced us. If you're searching for cheap vol.
Exactly.
So what does that look like? You're buying options on individual companies. You're looking at sector ETFs. You're looking at commodity options?
It
All the above?
individual equities, sector equities, commodities, currencies. Sometimes the cheapest way to express, some sort of disruption to a negative event potential in the market is via the currency markets, because that's where vol gets compressed the most. So that's an area that we've been pretty active in. But yes, it's an all of the above.
And you were never tempted to be, hey, I'm just going to go start like a commodity fund and trade futures and do all that? You always thought you needed the equity piece?
My real skill set, I like to think at least, is analyzing companies and trying to find ones where the market has misunderstood their ability to generate cash and their sustainability. The way I term it, and this is something I originally talked to Jason about a number of years ago, I'm looking for positive carry convexity. And that we focus on high dividend paying resource equities where you got a huge amount of free cash flow, 10, 15, 20% free cash flow yields, 5, 10, 15% dividend yields. And if you buy companies like that in periods of time where the valuations have been compressed, which is effectively what most of the last 4 or 5 years have been, then you get this constant, our strategy delivers double-digit dividend yields from the portfolio as a whole. So we get paid to wait. And we're just waiting for the point where either idiosyncratic things relative to the company give it a better valuation, or the sector as a whole gets positively re-rated. And with resource stocks trading at 125-year lows versus the broader market in terms of valuation, I think we're in a pretty good spot to potentially get at least a modest mean reversion in that.
I was just talking about this on our last pod, and I'll bring it up again. I wrote a blog post once called, Yeah, but the yield, right? I was talking about MLPs in 2014 when they just crashed. And a
Yeah.
lot of investors were saying, but the yield, I'm getting 9%. I'm like, but it's down 80. Like, so how do you square that? Of like, yeah, cool, you're getting this, but your price could decrease tremendously, right?
Absolutely. And that's why we're long short, but that's also why you got to be pretty selective. If you go in and try and buy the highest dividend in the sector, you're looking for trouble. What I prefer to look for is where we see companies that are generating so much cash at current commodity prices that they can pay a dividend, pay down debt, grow organically all at the same time. And so that's, this is a unique market where, as I said, the combination of resources becoming a lesser focus and less of interest to people, as well as ESG and decarbonization weighing on the entire sector, that has given me an amazing opportunity set to be able to express that in super cheap equities that can do all of the above. And they're, if you believe the dividend is sustainable, and we've got a pretty good track record, if what we focus on 100% is dividends, and I actually have been doing that for 17 years now, that is just the income side of resource equities. You get a pretty good handle over what are sustainable dividends and what aren't.
So like some of those are high for a reason. Price.
Yeah.
They're showing you how risky they are, essentially.
Exactly. But sometimes they're not. Sometimes they're just flying under the radar screen. I've got some European E&P companies that have given me 40% dividend yields over the last couple of years, that stock price is flat with a
E&P is
40% yield.
Exploration? What's E&P?
Yeah, producing companies. Yeah, exploration and production companies.
Yeah. And why does it need to be resource companies? Like, could you take your skills and be in tech? And I mean, they're not throwing off free cash flow. So that I answer my own question there. But whatever, are there other areas where you could apply the same skills?
I think it's hard to develop the skill set that, that gears me towards the resource sector. And I mean, a lot of it is understanding, like being able to look at the Venezuela situation and in 10 or 15 minutes go, okay, this is what I think it means. I don't know if I could, really don't think I could transfer that to any other place. I've got 35 years of scar tissue that I've developed in this sector trying to understand both the macro level of it and the micro level of it. I mean, if people are coming to me and pitching me, various, junior exploration companies in gold or copper, and it takes me 5 minutes to look at a map and say, oh, this was the project that they tried to do in 1997. But here are the reasons why it didn't work, because it was too far away from infrastructure and there was, too much of this in the deposit, so you couldn't refine it properly, or it's, you've got a town right next door who is going to come and protest it, or that's the sort of accumulated skill set. And when you've accumulated that in a sector where most of the skill sets have dissipated and the people who do what I do has fallen by like 80 or 90%, you might as well. I'm the tallest pygmy in the space, so I don't feel like I could compete in that way in any other sector.
Is that the PC way to say that quote now? The tallest pygmy?
Yeah. Well, I think we're in a less PC world than we were a few years ago.
For sure. So give me an example of some of these companies, of like what they're doing, how they can throw off that much cash flow.
Yeah. So I'll mention one that.
Yeah, you don't have to mention names, but just kind of what they're doing.
I've mentioned this publicly, in that our biggest position coming into this year is Schlumberger. Oilfield services company, great big global infrastructure company. It's the name that I mentioned when I was a speaker at the SOAN conference down in Australia in November. So this is a company that is this kind of perfect analogy of positive carry convexities. Over the last 25 years, the company's typically sold at a kind of a par multiple with the S&P 500. Oftentimes it's been a 25% to 50% premium. It's now trading at a 60% discount. It's, at least coming into this year, it was a 10%-ish free cash flow yield. So they were doing about 3 to 4% in dividend and another 5 to 6% in share repurchase. And that's for a $50 billion, there's very little left in the S&P, but like a big, easy to look at company. And this is a company that's going to be the biggest beneficiary of the movement of incremental oil production away from the U.S. and towards areas like Brazil, Guyana, and even the rebuilding of Venezuela or in Iran or something like that. That wasn't part of my direct thesis going through, but it's something that works for them. So,
and that's just modernization. Like basically all these countries are moving up the scale of modernizing, and they're going to be producing more and refining more.
Yeah. That's where the incremental barrels are coming from, because that's where people are finding the economic reserves. Growth in shale is not going to happen at $50 oil or $60 oil. Maybe it's $70 oil. But the nature of shale oil is that it declines very rapidly. And so when you don't apply capital to a production base that's declining very rapidly, the treadmill gets very, very steep or very, very fast. And so, what you're hearing right now from U.S. companies is that, we've got a president who we thought was going to be our guy in the White House, and all he seems to be trying to do is put a lid on oil prices down to $50 a barrel, and that doesn't make sense for any of them. So as the U.S. barrels flatten out and start to decline, somewhere else in the world has to win. And the people who've been doing the work to develop those projects over the last 5 to 7 years, Brazil, Guyana, the Middle East. And so that's Schlumberger's bread and butter.
Guyana. I don't hear Guyana. I like
Guyana's an amazing story. It's actually the best GDP growth story in the entire planet because of the oil production that they've been ramping up and over the last 3 or 4 years, and that'll continue. So that's one of the few places where global oil production is accelerating. They happen to be right next door to Venezuela. So that's caused a little bit of geopolitical tension over the last few years.
Is that basically the same reserves, the same basin?
No, that is mostly offshore. Some of it's onshore, but it's actually mostly much lighter, better quality crude as opposed to what Venezuela is involved.
And then the shale has another problem, in my opinion, right? That the playbook's out. Like as soon as they can start producing and making money, Russia and OPEC will just flood the market and drive the price back down to take them out. So I don't know how many times they can do that, but that was the playbook back in whatever that was, 18.
And in theory, that's what OPEC has been doing now. They brought an additional, almost 2 million barrels a day, or maybe a little bit more, back onto the market over the last 6 to 8 months. ahead of schedule. Some would say that that's been a little bit of kowtowing to the U.S. administration, who wants lower oil prices going into the midterm elections, and happy consumers who don't pay a lot at the pump are much more likely to vote for the incumbent than they are to vote them out. That said, OPEC capacity, if they really are producing where they say they are producing, there's not a lot of that left. And so the surplus in the market has been wound down significantly. What people have been saying is, well, if they're coming back with 2+ million barrels a day, there's going to be what they term a super glut. And, these barrels should be piling up everywhere. The fact of the matter is they're not. And so I'm not going to argue that we're in an incredibly tight market right now. We're not. We're oversupplied, but we're not oversupplied by 2 or 3 million barrels a day. We may be oversupplied. Numbers and inventories that I look at, maybe 500,000 barrels a day or more. That can tighten up pretty quickly in a geopolitical world where if all of a sudden you get, for example, a fall in Iran or a fall in, or a Venezuelan, you get one of the 275 generals decide that he wants to be in charge as opposed to the one that the U.S. decided was going to be the case. You could see 1 million or more barrels go offline very quickly. So exactly. So I think I kind of like where the crude market's at. I don't think it runs away to the upside, barring geopolitical volatility. But I think the focus on we're super oversupplied and we're likely to see 40 before we see 65, I would disagree there.
Back to your Schlumberger example for long short, are you specifically picking out a short to offset that long? Or it's more of like I'm picking out equally weak positions that I think aren't a good story and going short then?
So truthfully, what I'm doing with that now is I'm long Schlumberger, which is, as I said, historically depressed multiple with very positive catalysts going forward that I don't think the market is incorporating. There's a lot of other stuff that we didn't talk about. I think Schlumberger is about the most legitimate AI play out there. They have an entire section, Schlumberger Digital, which if it were a standalone tech company would probably trade for something close to the entire market cap of Schlumberger, and it's only 6% of their revenues.
Oh.
So there are a lot of other things that I like about Schlumberger.
Maybe
the flip
when
side
Dick
of that is
Cheney died, it got it went on a discount.
Yeah, well, that was Halliburton. So
Halliburton.
he was Halliburton guy.
All right.
But the flip side of that is, I think the Gulf Coast refiners are ridiculously expensive relative to the fundamentals, and they've been a favorite of the zeitgeist because clearly all more Venezuelan crude is going to come to market and be to the benefit of these guys. I think that's 2 to 3 years out at best. And what you see from some of these Gulf Coast refiners is they're trading at the most expensive multiples that we've ever seen them at versus the oil service guys trading at the cheapest multiples we've ever seen at. And if you look at crack spreads, which is the best real-time indicator of their profitability, they've been going straight down for 4 or 5 months. So
gas versus oil, it's the crack spread.
Yeah. And so it looks at the profitability, the theoretical profitability of running oil through a refinery in a certain ratio and selling that at current gasoline prices. And so their leading indicators of profitability have been going straight down over the last 2 months. And yet the stocks, because of this theoretical benefit that I think is years away at best, the stocks are jamming and actually it looks like they want to break out to all-time highs. To me, that's the sector that I feel like is a pretty good short.
So you're not necessarily trying to match up positions like a classic, like I'm going long Coca-Cola, short Pepsi, whatever the classic example is. It's more of
I do that some, but mostly it's in broader buckets. So I've got a lot of different ways that I can short within the energy bucket. So I view both of those as kind of energy things. So I'm long service, effectively kind of short refining. I can be long short within different subsectors. This doesn't happen to be an example of that.
I can't put you in a box. We've spent all this time on energy, but that's only 2/3 of what you do?
Roughly a third, actually, just a third.
Only a third of what you do. So let's get into all the other stuff. So what else is resources in your book?
So Precious metals has been a focus for us for the last couple of years. That's been a pretty
Good
fun
call.
place to hang out.
Yeah.
It was awful, and we were early, going into particularly kind of the tail end of 2024, where the gold price was going higher and the gold stocks were not. But that rectified itself last year, which was great to the benefit of us and our LPs. I do think, people try and make the gold thesis really complicated. They're like, it's inflation, it's deflation, it's real interest rates, it can be any one of his. I think I think the gold thesis is actually, when you back away from it, it's pretty simple. Is it a useful diversifying asset? And what I think got the central banks buying gold 4 or 5 years ago was the fact that gold was providing a significantly better offset to US treasuries and other currencies and US dollar assets than US bonds were. And at the time, the rest of the world was super overweight US bonds. They still are overweight US bonds because from 2000 to 2020, US bonds were the perfect hedge, right? Because the reaction function of central banks was every time there was a quake in the equity market, they would come in, cut rates, and bonds would go higher. But if you look over 150 years of history, bonds and stocks are only anti-correlated in inflation environments of less than 2%. If you look at an inflation environment of, say, 3% or higher, which is, I think, more likely the environment that we're going to be in, equities and bonds are either uncorrelated or positively correlated. And that's what 2022 showed us, right? And that bonds and stocks can go down at the same time. So the entire gold thesis being about some sort of death of the dollar or, whatever else, it's not. It's a really good portfolio allocation. The central banks figured that out first and started putting money into it for the better part of 2023, 2024, and even the early part of 2025. Western investors, both institutional and retail, were very happy to sell the central banks their gold. We were liquidating as they were buying. So that kind of kept a lid on gold prices. They were going up, but they weren't going up very quickly. The thing that changed in, second, third quarter of 2025 was that the sellers stopped selling and started buying a little bit. And when you have a market that was sort of positively biased, but with people on both sides, to now really positively biased and kind of everybody's just a buyer. That's what turned in the gold and then silver and then PGMs kind of move that we saw last year. And so that's a long way of saying the catalyst for gold doing well, I don't think changes unless you see an environment where we think we can sustainably get inflation back under 2%. And where people trust the US dollar more than they did yesterday, which I think, starting with the Russian confiscation or the US confiscation and European confiscation of Russian foreign exchange reserves back in 2022, and I think even more accentuated by our willingness to sort of, do these rifle shot decapitations of various governments around the world. I think that's a long shot. I'd say that's not a high probability event. So I think those dynamics stay in place. I would not expect the pace of precious metals appreciation to continue. I think we will get a volatile ride, but I think over the next 3 to 5 years, it's still up and to the right. It's just going to be maybe a little bit more boring and a little bit more choppy.
Do you think Mexico's rushing to buy U.S. bonds, or Denmark? Over everyone is being threatened right now. Let's maybe look at something else.
If anything, it's the opposite, right? And I wrote a long piece right after the tariff tantrum back in April, where if you look at the VAR shock to foreign holders of U.S. assets, they lost on a percentage basis in the 6 weeks around the tariff tantrum. They lost twice as much in percentage terms. So I'm talking about foreign holders of U.S. assets, U.S. equities, U.S. bonds, U.S. government securities. U.S. Mortgage securities and things like that. They lost twice as much on a percentage basis and 10 times as much on an absolute basis in 6 weeks around the tariff tantrum than they did during a year and a half during the global financial crisis.
Really?
So if you're a European holder of U.S. assets, that was quite frankly, an oh my God sort of moment. You had never built into your VAR models what that did. Now, what surprised me is I thought they would start selling U.S. equities to reduce exposure, as well as bonds. They sold some bonds. They actually kept buying equities. What they did is they hedged their currency exposure. They had been holding U.S. assets unhedged because the currency actually helped them in previous times of market dislocations. But that was definitely not the case in April of last year, and it hasn't been the case for a while. So they started to hedge the currency exposure, and that's why the dollar has been relatively weak ever since then. It really hasn't done much in the way of rally, even though U.S. growth has been much better than the rest of the world. So I've been surprised that the rest of the world is willing to come back to the trough on this, but eventually, maybe they don't.
Well, and it seems they also were buying, especially in Europe, right? Like they were buying their own stocks. European
Exactly.
stocks went gangbusters.
Yeah. And we've got a record portion of our fund is outside of North America. So we've got about 65% of our holdings are non-North American, which is unusual for us because there's a lot of resource companies in US and Canada. But there are a lot of things about Europe and Australia and, even parts of Africa and Middle East that just, quite frankly, are just much more attractive right now.
Just want to circle back something you said, 24 gold prices were rallying, gold companies weren't, right?
Yeah.
For me as a futures commodities guy, I'm always telling people like avoid the companies. Yeah. They've got warts, they've got the commodity exposure plus debt, plus management risk, plus yada, yada, yada. So how do you square that? What's your calculus there of why you'd rather be in the company than the commodity?
Yeah. The companies provide a couple of different things. They can provide, unlike direct investing directly in the commodities, they can provide an income stream, right? So if I'm choosing a dividend related company, I get a positive carry on that. And again, the second part they offer is convexity. For a lot of these companies, the move from $2,500 gold to $3,500 gold. So gold went up 40%. A lot of these, that meant their earnings doubled or tripled. And so if you get into a market where people care about that, which historically they have, in a good gold bull market with people paying attention, gold stocks will outperform gold 3 to 5x on the upside. And so, look, it takes a lot of work to understand the idiosyncratic risks of individual resource securities. And it's not something that I recommend to your average individual investor. And it's even something hard to do institutionally, because quite frankly, the number of people who follow these companies who really know these markets has shrunk pretty dramatically. But that makes it the opportunity set that it is to be able to find ways where, look, I can, I had a couple of my gold stocks up 200 or 300% last year. Gold was up 50. So that's the reason why.
And that math, well, that can work both ways, but that math is simply they have mostly a fixed cost, right? Like, sure, it'll fluctuate a little bit, but if the thing I'm getting out of the ground now is twice as expensive, I can sell it for twice as more, and I'm still paying basically the same cost to get it out.
Yeah, so I can illustrate that in a vivid example in that I met with one of our key portfolio companies in September of 2020 at the Denver Gold Show. September of 2024 at the Denver Gold Show. I think gold was roughly $2,500 an ounce. And their project that they were bringing online was going to generate about $200 million in free cash flow in the first year of production, which was 2027. And the market cap was $600 million. So it's trading at about 3 times free cash flow. So look, that's good, pretty cheap. Fast forward to a year forward at that same conference. So September of 2025, gold price is up by over $1,000. The stock is up a couple 100%, but it's a 1.8 billion market cap, but the free cash flow in the first year of production, it's like $850 million. So it's a cheaper stock, even though it's more than doubled. Wow. So more than tripled. So that's the kind of inherent operating leverage that you get. And look, there are a lot of crappy companies in this sector. And so that is not the case universally. And I see, if I'm looking structurally, like I've got geologists that I keep on retainer and great contacts that I know through 35 plus years in the business to be able to figure out what are real deposits and what aren't. And if gun to my head, 3/4 of this sector, I'd rather be short than long because the business models don't make sense. But when you find the good ones, man, and you get the tailwinds that we're starting to see, and I think we'll continue to see for the next couple of years or longer, I'd much rather be in the equities than commodities themselves.
And that's why you look at it as a convexity play, basically. Like, hey, I can
Correct.
get this, I'm paying this premium, or even I'm receiving a premium in a lot of cases.
Yeah.
And I have
Yeah.
upside.
Massive, massive positive carry, double digits a year. We've generated at a fund level 14% annualized yield from our underlying securities, coupled with serious convexity. If you're right, either for idiosyncratic reasons to the company or broader sector reasons that you get the commodity right.
Were people back at Franklin Templeton, or even in your early days of like, why is this guy talking option terms with resource stocks? Like, who is this guy? Have
Yeah,
you
I
bumped up
wasn't.
against that? Like, most resource guys are like, oh, the deposits and right. They're talking a whole different language than you.
Yeah, geology versus finance.
Yeah.
Yes, I would say I wasn't talking in these terms, 30 years ago at Franklin. But it's when you start to, I find it, I think, very useful to think about all investing in terms of option terms.
Yeah.
What's your upside convexity? What is your theta? What is your, I mean, there's just
Yeah. What's your break even,
all,
basically? Yeah.
all of the Greeks make sense in terms of part of a toolkit to be able to understand what your expected path function for returns are.
But do you have trouble explaining that to investors in your fund? Right? Are they like, what? I just want exposure to gold prices.
Yeah, I write about it a lot. It's
Yeah.
the ones who care to comment actually get it, but there may be a lot who don't. Most of the folks I never hear from, so that's
Yeah.
fine too.
So energy, precious metals. What else we got? What else is under your resources umbrella?
So we talked about tankers a little bit. That's a little bit kind of tangential to to the energy trade. Also, look, we're involved in kind of base metals and infrastructure. I probably there. I think it's kind of more interesting in. I'm a little bit of I like the empty rooms. I'm more of a contrarian. So the laggard to me in the base metal complex has been nickel. So I think there's some kind of interesting opportunities there. We've got some niche rare earths exposure, but I think that the fundamental analysis in the rare earth sector has gotten a little bit polluted from watching an administration who, while I think they're doing the right thing, this is an area that we should have been investing in and backing strategically for, we should have been doing this 10 years ago. If I was to pick a fight with what they're doing, they seem to be doing it not with the best quality assets or the best quality people, but the ones that are closest to the administration,
Yeah, that's the
fine.
playbook. Yeah.
That's the way the world works. So I think they're interesting opportunities. I think they're going to be fantastic short opportunities in the rare earths and strategic metals over the next couple of years as government subsidies bring on more production than we probably need in the short term. And the bloom will come off the rose in terms of the US because the valuations on the vast majority of them make no sense whatsoever.
Do you put uranium inside of that? Inside of
No,
rare earths, or a separate deal?
that's a separate deal. And I like and always have liked the uranium story because for those who actually understand what if you're looking for decarbonization or steady baseload power, look,
Only answer.
yeah, nuclear's been the right answer for 50 years, right?
Yeah.
You compare France's CO2 output with Germany, and you see how incredibly self-immolating the energy venda, shut down your nukes to build a bunch of wind and solar in a place where it's not cold. No, it's not. It's mostly dark and it's not windy. So
Yeah.
it's just it's lunacy. But yes, nuclear is a great answer. It's going to take time. I think traditional nuclear is a much better and more likely winner than things like small modular nuclear. I think there are a lot of technical challenges to that, and that's going to be a long time in coming. I like the uranium story in general. It's hard for me as an equity investor to express it because one of two things: either the companies don't pay dividends because they're all kind of on the come, or the ones that do is like you can buy Kazatomprom, but you're taking on a very different geopolitical risk with that. And so from that standpoint, and look, as a value guy, the way I like to qualify it is gold investors on a scale of 1 to 10 in terms of their zealotry. Gold investors are probably a 7. Silver investors are definitely a 10. Uranium investors are turn it up to 11 or 12 in terms of their zealotry and willing to pay high multiples for potential returns. And so I think what we all know is if you overpay for an option, you can be right and still be wrong. So
I'm like a 9 on that scale on the SMRs. The maritime guy, we were talking about putting small modular reactors on tankers.
Yeah.
And he was saying, like, back in Seattle in the East or something, they were actually plugged an aircraft carrier into the grid in Seattle.
Yeah.
In the 80s at some time, and we're driving power to the grid. So he was like, you could actually pull these tankers in, plug them into the grid.
Yeah.
So that's interesting. But then again, that's hugely expensive, right? Like, what's a tanker cost now? What's it cost with a nuclear reactor?
Yeah. And look, the government can underwrite that. And that's been true with, the U.S. Submarine fleet has been, run off nukes for a long time. So the technology's there. It's simply
it's when
getting to
people
the
are like,
point
it's
where
too
we can,
dangerous. I'm like, we've been doing it for 60 years.
Yeah. Yeah. It's the likelihood of accident or fallout is not a serious reason not to consider nuclear.
Where does this all go next? The threats to Mexico, the threats to Greenland, is that all a resources play, right? Greenland seems totally a resources play. Or is that more air defense? Who knows?
I would push back a little bit. The geologic potential of Greenland is reasonably high, but when you see these, U.S. Geological Survey studies of, in situ values of minerals, it has nothing to do with economic recovery. So I don't think it's a potential rare earth powerhouse. I think it's much more about a combination of shipping lanes, which when you control Alaska and Greenland, you got both sides of the Arctic, channel that go through there. And also, if you look at the places that the Soviets would launch, Russians would launch any sort of attack our way, all of it goes over Greenland. So I think there are a lot of different parts of the mosaic that are valid. I would play down a little bit the resource angle, but I think it's all part of what I think has been consistent in what is developing in the current administration's geopolitical doctrine is they effectively want to control the Western Hemisphere.
The Don Road
top to
doctrine.
Top to bottom. And, it would then surprise me if we go in and do the same thing that we're doing in Venezuela to Iran. Iran may go that way, it's on its own. But so I think what it all highlights to me is that most commodities and U.S. equity markets are priced like geopolitical risk is a very low probability outlier event. I think we're in an environment that could be much less stable than that. Because when you go in with a surgical administrative decapitation of a sovereign nation, I think there's a lot of the rest of the world that's feeling a little bit like a cornered animal. And cornered animals do things that may in other environments not really make sense. And so I think we're in a period where you want to be long volatility, you want to be long what most of these countries are fighting over, which is raw materials. And I think paying record multiples for S&P 500 and de facto paying more than record multiples for tech at this point is terribly self-serving, but I think that doesn't appear to me to be the best bet if we are in a heightened geopolitical risk environment.
I'll flip it on you. If they bring you in, they're like, hey, where should we take over next to get access to these resources?
Yeah.
Guyana? Besides Guyana, we already mentioned that.
Yeah. And we're doing that from a nice, friendly handshake, capitalist standpoint in that it's mostly U.S. oil companies that are partnered with the Guyana government. Yeah. So we've got that and we don't have to fire a shot. Look, there's a lot of things that we could be doing here in the U.S. that, in terms of actually exploiting, rare earth and cobalt and things like that. There's a lot of that here. We don't have to go and take over the Congo to get it. The problem that we have is that we're boxing ourselves into the corner in that if we want to be the world AI champion and we want to onshore the development and processing of many of these very critical materials, the U.S. grid can barely do one of those two things. It definitely can't do both. The problem if the U.S. grid can't do it is that prices to consumers are going to go up and whoever's in office is going to get thrown out of office. It's not like there's a lot of...
We've already seen that near the data centers and whatnot, right?
Absolutely. And you're starting to see cancellations of kind of 2027, 2028, 2029 contracts for what people have thought would be data centers, where people are like, I can't get the power for it. Never mind. Here's the keys, back to you. So I think that's the point of tension, is that we are resource and energy constrained, and if we are resource and energy constrained, should all of materials and energy be 3.3% of the S&P 500?
Probably not.
Probably not. Right. So
what'd you say historically was 15%?
Yeah, history just energy alone was 15. So right now it's about 2.8% for the energy, and call it 30, 50 basis points for the rest. That was as high as like 18. I mean, if you go back into the late 70s, so here's 70s, it was 35, maybe as much as 40%. You go back in history when resources are really a thing. Schlumberger was the third largest market cap company in the world, behind General Electric and IBM. Actually, fourth: General Electric, IBM, and AT&T. Schlumberger was number 4 in 1979 because it was a technology way to play resources. Yeah. So I think we're going back into an environment,
like we had to explore, we had to do all that.
Exactly. Yeah, and I think we're going into an environment where it might look a lot more like that over the next 3 to 5 years.
You mentioned your son. I've got a junior in high school. We've been starting to look at colleges. Where's your son looking at schools?
Oh, he's all over the place. Good news is he's done everything from a building his own resume standpoint to give him a lot of options. But, we all know it's a crapshoot. He's mostly looking East Coast. My wife grew up on the East Coast, and so we've actually spent a lot of time back there. And, as a Californian, I think they're both. I have an older daughter who's at school up in Maine right now, and all of my kids are interested in exploring other parts of the country. We love California, but I think I ended up doing time in Colorado and backpacked around the world, and did all kinds of stuff. And I think they've got that same inclination. But if you want to share notes on any college on the Southeast and even some of the Midwest, we've got them, so we can talk offline.
Nice. Yeah, my wife thinks whoever sees the most colleges wins. So we've been going all over. We were out in your neighborhood, saw Stanford and Santa Clara, which was super nice. I didn't know that was so nice, right there in Silicon Valley.
Yeah, I think we're supporting GDP just on our application fees this year.
Little tick up on the applications. Well, good luck to them. You weren't telling them Colorado School of Mines, like learn how to find all these resources?
He's really interested in kind of biomedicine. And so he's a very STEM-y kind of guy, and I'm going to encourage him to do that because he's really good at it. So,
amen. Cure cancer for us.
Yep, that's the plan.
All right, Robert. We'll let everyone know how to get a hold of you in the show notes. So thanks for coming on, and we'll talk to you soon.
Real pleasure, Jeff. Look forward to following up whenever you want to have me back on.
For sure. You're going to be my go-to energy guy now, even though you're only a third an energy guy. Pretty good for a third only.
Yeah, I've been doing this a long time. So, old dog. Not sure I have many new tricks in me, but the old ones are working pretty well.
You've been listening to The Derivative. Links from this episode will be in the episode description of this channel. Follow us on Twitter at RCMAlts and visit our website to read our blog or subscribe to our newsletter at rcmalts.com. If you liked our show, introduce a friend and show them how to subscribe. And be sure to leave comments. We'd love to hear from you. This podcast is provided for informational purposes only and should not be relied upon as legal, business, investment, or tax advice. All opinions expressed by podcast participants are solely their own opinions and do not necessarily reflect the opinions of RCM Alternatives, their affiliates, or companies featured. Due to industry regulations, participants on this podcast are instructed not to make specific trade recommendations nor reference past or potential profits, and listeners are reminded that managed futures, commodity trading, and other alternative investments are complex and carry a risk of substantial losses. As such, they are not suitable for all investors.